All right, well, I guess we'll get rolling here. Hopefully this weekend's been good to you guys. Episode 16, Stocks Explained to the Beginner. CDs versus stocks. Which is better for the investor long-term growth? Brian Reich, my website, makestocksfun.com. If you want a transcript of today's seminar, please check out my website under blogs, makestocksfun.com. Quote of the week: it's how you deal with failure that determines how you achieve success. David Faraday. And this statement is absolutely true. Most people have been hurt by the market and fearful getting back into it. I know how you feel, and my promise to you is I can help guide you to stock success. My name is Brian Reich. I'm a successful stock investor, and my goal is to become a stock millionaire. In these sessions, I want to pass on my knowledge of wins and losses so you can enjoy the success I've had today. In last week's powerful episode, we discussed, are you planning for the next crash? We discussed events that could lead to the next crash, such as student loan debt, cashless government, AI, dealing with robots and technology, China, or nuclear war. And the industries we discussed to be a part of when the next crash happens would be like 3D printing, maybe electric takeoff vehicles, stem cells, drones with Amazon, Home Depot, Uber, Tesla, or Apple. And last week was a must-watch for those who missed it, and rewatch for the ones that were present. I really liked the content last week. CDs, or certificates of deposit, have been offered by banks, sold funds for an exact duration of time. This gives the bank security when taking out short and long-term loans. CD rates are usually higher than savings rates because there's a penalty for early withdrawal. And stocks are offered by companies that are publicly traded. Stocks give the investor a chance to make a greater return if the company expands and grows over time. People have been using both for over 100 years, and today we'll examine which gives the investor the best bang for their buck. What does the bank do with the CD money they receive from their customers?
Taking risk, you have loans.
And that's where it comes, yeah, somebody laughed, and I have to laugh too, because what exactly goes on is anybody's guess. They do have like an investment banking team as well. So, I mean, if they're paying you 5%, they turn around and obviously they want a greater return. So they, a lot of times, will invest into stocks. CDs, interest is on the rise, and it was just a short time ago when you're lucky to get 2% rate of return on your savings account. I have a Synchrony CD, and last year I called to update my rate. The previous year, my CD account was earning a whopping 1.7%, which I changed to 4.45 and felt like I discovered plutonium. September 20th, this Fed will get together again and decide if they'll raise the rates. And they have 11 times previously, so I'm almost positive that they will again. High yield savings account, UFB Direct. They offer 5.25, and if you're interested, like a jumbo checking with savings, Sophie Checking Savings gives 4.5%. Top CD rates that I researched this week: Western Alliance, they have a 5.25 rate over a 3-month duration. Ocean First has a 5.15, and Ponce Bank has 5.4 in 3-month duration time. Belco Credit Union, 5.25 for 6 months. First Internet Bank, 5.25, 6 months, and Western Alliance Bank has a 5.45. CIBC Bank has a 5.36% over a year time frame. Popular Direct has a 5.5 over a year. And then Delta Community has 5% in 2 years. Crescent Bank has 5% in 2 years as well. So those are the top rates I have found when I researched this past week, checking things like Kiplinger, Smart Money, and like Bankrate and NerdWallet online. Stocks, they say as interests rise, the stock prices historically decrease. And why is that? Because the investors, they will take their money from their stocks and put it in the CDs, expecting, getting a safer rate of return for their money. I personally love stocks. Even if CDs went up to 10%, I wouldn't even flinch. Why is that? Because can you really double your money in a few months with a CD? Can you earn more shares of a great company with a CD? In my opinion, stocks are still the number one investment. And sorry, CDs, my number two is real estate after that. And these are the ways you could double your money in 2023. Tesla is down to 107 as of January 4th. The high was 292 as of July 18th. Facebook was a 122 on July 3rd, and then it reached over 322 on July 28th. Trade Desk was $42. The high was over $90 as of July 17th. World Acceptance was $62 on January 3rd. And as of July 31, they were $157. So these were just some, 4 examples that I'm familiar with doing my own stock research, and a couple that I own, Facebook and Tesla. I personally doubled my money on those. In fact, this year there were 82 companies have doubled since the beginning of this year. That's 82 opportunities that you could have doubled your money. And do you know how to figure this out?
Rule of 72?
No, I mean, do you know like how you can find these companies that have doubled since the beginning of the year? Or methods? I know of a couple, but I mean, do you know of any personally?
Not besides just basic, like a broad research.
Okay. So this is how I do it. I go on Finviz.
Sorry.
Yeah, finviz.com. And then FINVIZ. And then under technical, I pick, you go to this performance, half plus 100%. And then under descriptive, I go over $20. And then it returns stocks that have doubled basically since the beginning of the year. So, and you can, you can go under technical, you can play around with the different numbers. You can do it by quarter or what have you. But if you're ever interested in searching stocks this way, I'd highly recommend this FINVIZ. It used to be Yahoo Finance. I used to do that a lot until the screener changed. And then when I looked for a better method, this was definitely it. And it's free, but you just have to put up with their ads. But it's definitely the best screener out there that I'm familiar with. Now, I know the next question on your mind, could I piggyback my stock gains and daisy chain them together so I could quadruple my money in 2023? And here's my daisy chain example, starting with 10 grand. If you bought Tesla January 3rd for 107, sell June 7th for 220 a share, then 10,000 would grow over 20 grand. If you took your 20 grand, bought MLTX on June 8th for 27.62, sold for 57.60, your initial 10 grand would have grown just shy of 50 grand. Then for the trifecta, if you bought 27.54 shares of USM on July 24th, your shares would be worth 45.87 as of today. Your initial 10 grand would be worth 78,000 within 8 months. Wow. And this is considered kind of like a down year by a lot of experts. But I'll give you a short bio on these companies that we're discussing. US Cellular, they're basically a smaller version of T-Mobile or Verizon. Why the mind-blowing acceleration in stock price, you might ask? It's just because they had a lawsuit that took place and finally got finalized. And it was all in regards to their 5G. So now their 5G network can roll out faster. So it excited a lot of investors out there. MLTX, MoonLake Biotech, they're a foreign company. They have treatment of inflammation diseases. The reason for the hype, a new drug in a pipeline to treat skin inflammation. So it's very exciting what they're doing, and investors are taking note of that. And that's why this stock doubled. My honorable mention, Carvana, right here locally. They started in Tempe. You might have seen them as you're driving on the freeway, like the 202. They're basically a car vending machine. Believe it or not, they were $5.11 back April 24th. Now it flirts with $51. So it's companies like this they just got to keep an eye on. I was just wondering, just curiosity, like who would buy cars from a vending machine? Like how much off list do you feel like you would need as an incentive to buy a car this way?
I heard somebody said not to buy from them.
You heard bad publicity from them?
I heard that the recommendation was not to buy from Caravan, just go to a dealership.
Yeah. And personally, I like the dealership just because I buy brand new and I keep my cars over 10 years. Cars are like one of the ways you can go in debt, right? I mean, if you buy or if you lease or buy a car every 2 years, you always stay in debt to the system. I found if you buy brand new, keep the car over 10 years, you have a better chance of winning a car game. And I feel like I rather just buy from the dealership because then you have kind of their backing. I like AutoNation. They're a company that's publicly traded, and I personally back that stock because I'm treated with respect every time I go in there, and they address what concerns my car will have in the next 2 to 3 years and what I need to do for maintaining it. And so far, it's been a great relationship, and I'd highly recommend them to everyone. So in essence,
Which dealership?
yeah, I'm sorry. It's called AutoNation. They're nationally known, very well respected from all the people I talk to. Was there a chuckle or something?
Well, let me tell you, I worked for Toyota Corporate for 35 years.
Oh, there you go. Nice.
Yeah, they were a little bit, they got into some trouble early on. They're not as respected as you may think.
Oh, really? Oh, okay.
No.
Maybe they.
They're mass retailers, what they are.
Right. But did they fix some of their problems recently, or?
Well, they don't stand behind their product. They've been known to resell cars that have been in floods, and they've gotten in trouble for that before.
Oh. Well, thanks for bringing that to my attention. I had no idea. Yeah,
Yeah,
I can relate to. Yeah.
Be careful.
Okay. I can just relate to my own experience. When I had a Toyota here, I was treated very well. I love Toyota. I would never talk anything bad about them. If anything happened to my Nissan, I'd buy a Lexus, probably from Superstition, because they have the best ratings and reviews. And when I go to Superstition, I'm treated like royalty there, and that's the way I like to be presented. So.
Yeah, of course.
Right. And Toyota, Wright Toyota here, I can only just talk very highly of them. They're very reputable and always had a good experience there. So in essence, yes, you can double your money and double again, and yes, almost tripled it the third time. The third time in 1 year, and the year's not even over yet. The other question, how common is it to double your money in a given year? The answer is, if you're doing your homework and watching opportunities, or the best way I'm going to tell you, join our newsletter, because we'll continue to find and be a best resource for you, and then we'll point out opportunities as they come up. There are always double bigger opportunities in a given year. There are always, opportunities make 30-40%. Quality companies, if you look at best stocks book, every stock listed has an average of 30% low to high that you can gain in any given year. I love stocks always. Why? You get ownership in real companies. You have the pleasure of voting on how your company is being run. With a guide from a professional, you can get higher rates of return via the stock market. Some of the benefits owning stocks, dividends can go up.
Yeah, we don't hear Brian.
Yeah. Okay.
Do you hear me now?
Yeah.
Yeah.
Okay. Yeah, I think it has
I
some.
have a question.
Yeah, sure.
Short-term profits, capital gains. What do you do with your capital gain? I mean, that's it's a huge tax burden. What do you? I mean, profit is is excellent, but it's a capital gains issue when you're making it under 1 year. So how do you handle that?
Right. Well, I do most of my short term in my IRA accounts, but if I did it, Yeah, but if I did it just on my own and did it year after year, you could set up a company or a LLC and seek like a tax professional. There's always loopholes to avoid tax, some of your expenses, buying a car, different things like that, interest rates on homes and mortgage rates, you can deduct from that. So
Right.
the rich remain rich because they're knowledgeable, right? I mean, they go through these extra steps of perfection. And, I would always recommend that you don't concern yourself too much with making money because if you won,
I wanted to clarify that.
no, absolutely. No, it's a big concern. Taxes is one of the major expenditures that you're going to run into, especially on short-term stuff. Like I'm up Facebook, Tesla. I haven't sold them. I love those companies long-term. I love them in 2030. So, unless the stock went way up, that's the only reason I would get out, and my attention would be buy back in on a dip.
Well, definitely. Let me. I'm probably a little bit older than most of you on this call. I've strictly been involved in mutual funds now. I'm in ETFs.
Okay.
I've got it in my IRA and also my Roth IRA. I do very, very well.
Good.
I buy on the dips, and I hold them, and I sell them when my profit's reasonable. Put it back in my brokerage account. Don't get taxed on it, and then I buy more on the dips.
Okay.
I play it's strictly ETFs.
Right.
And they, I'm not trying to burst your bubble on stocks, but
No.
I'm sure you picked a few not so good stocks, correct?
I used to, when I was learning back in like 2015, there was definitely a learning curve. I had to go through the losses, but now, like I'm not gonna, if I buy into a company, I'm not gonna say it doesn't go down. It does. I pointed that out through the weeks, companies I have bought, and what I do is I buy in a dip to even them out. I just did that with IIPR, 3M to name a couple. But the ETFs are nice, and mutual funds, I have no problem with that. It's just you got to look at they're a middleman, right? So you're giving them the money and they're buying stocks anyway. So you could.
No, they're strictly they're index funds. What I use.
Right. Well, they're buying the market, right? In the index funds, they buy stocks directly from that index. So if it was S&P 500, they have an index of 500 companies that they're buying in and selling out at. My recommendation, you can do it yourself and make more money. That's the upside.
No, I do. Well, think about it. 0.01% on the S&P 500 for Vanguard is not a bad deal.
No, it's not. And I was with Vanguard for a long time, and they have great funds to offer, and their load is very, very little. So yeah, you're with a great company in Vanguard. They've always been number 1 and 2 with Fidelity. So no problem with that. It's just that, when there's a dip, like I had in pandemic, you're not going to make 400% on a fund. Like I made 400% on Tesla. Those are the incentives. So it's great you have this, but my idea for you is just have a little on the side, and then throw a couple Hail Marys, go for the end zone when you feel like there's a Carvana opportunity at $5 a share, something like that. Does that make sense?
Well, yeah, it makes sense. And I'm both my IRA and my Roth. I'm over the number I want to be at.
Over your number? What is that?
I'm over $1 million in both.
Oh, okay. Yeah, good. Yeah.
Plus, I'm doing. I'm moving from my Roth to my IRA.
Ah, great. No, congratulations on your success. I'm proud of you, for doing that.
I'm just listening. I didn't mean to interrupt you, but and I'm looking at another way to do things. That's why I'm here.
Yeah. Well, no, I'm giving you some guidance on what you can do, and stocks going direct is a great way to do that. And especially when you have a plan and a long-term goal or an agenda, then your odds of success are going to be a lot greater than if they were in the short term. Does that make sense?
Yes.
Great. And I just want to point out these things do happen to ordinary people. You just have to possess, the skill set and acquire new contacts who know how to get their job done. As my buddy always used to say, no change is no change. If you don't, take risks in life, you'll never discover anything new. And you know, this year definitely has some things to offer you. I do have a Paper Trade Club on my website, and we can look at it real quick. And
Brian, you mind if I ask a quick question?
yeah, sure.
Do you have any other way any other method that you use to evaluate these companies besides FinViz? Like you see one that seems like a good deal, and then do you look?
Oh yeah, and that's a topic. We're cutting it short here, but yeah, I do go a lot of analysis. I have a spreadsheet. I get to my Elite 100 because I have a rigid thing that I go through, big charts, and going through MSN finances and going through earning per share and everything like that. So yeah, in the next couple of weeks, we'll dive into that more of what my rigid process is and how I go through those steps. But I literally go through 100 companies a day looking for opportunities, and I compare them with what I have already. Does that make sense?
Yes.
Awesome. So I put you guys on here. This is my MakeStocksFun.com and my paper trade. Last month I had a contest, and Melissa won that. And it's fun to go here and just kind of look at, you know, everything's updated 5 minutes. I'd strongly urge you to have a log like this in the beginning when you're venturing out to take stocks on your own, and just kind of seeing how this is kind of a guide to see what your stocks can accomplish and the goals that you can hit. And obviously no risk, and it's just fun, and you know, I'll have little contests as we go on. But I think this is a great resource and a great way to start. Does that sound good?
Yes.
Awesome. Well, I appreciate the seminar. It was fun with you guys, and we'll go ahead and look forward to the next few weeks, and we'll dive into some other areas of interest.
I have a quick question. In your reading there, you said there's a book, Best 100 Stocks. What is that book?
Yeah, that book, I was looking for at Barnes the other day. I don't know if they do it anymore, but it's definitely on Kindle. Yeah, you can go, I think in 2012, every year they release a new edition year after year. And I love to look at that book because every year they would update it. It's weed out stocks they didn't like and bring on new ones. But I was just fascinated by looking at the charts and the numbers. And every year I pointed out, given any stock, Archer Daniels or whatever they had in it, Target or what have you, there was always at least a 30% opportunity year after year that you could get your hands on. So I definitely recommend that book. Well, thanks, guys. I really appreciate it. I wish you well the rest of the weekend, and we'll see you next week.
Thank you.
Bye-bye.